Every year, the Social Security Administration sends you a statement. It arrives in your mailbox or appears in your online account with your name, your complete earnings history, and a single projected benefit number that you probably treat as official. But here is what that number is actually built on: an assumption that you will keep earning your current salary every single year until the day you claim. Not a range, not a projection with a margin of error. A straight line assumption. The Social Security Administration's own 2020 briefing paper, number BP202001, confirms this in plain language. Your statement uses your most recent year of reported earnings and assumes you will earn that exact amount every year into the future. If your most recent year had zero earnings, they use the year before that. If both are zero, they assume zero future earnings. The Internal Policy Manual POMS section RM01310.005 says the same thing. The system looks at what you earned last year and runs that number forward like a ruler. Now look at the three estimates your statement shows. One for claiming at 62, one at full retirement age, which for anyone born in 1960 or later is 67, and one at 70. Each of those estimates assumes you keep working until that specific age. The age 62 estimate assumes you stop working at 62. The age 70 estimate assumes you work until 70. That means the age 70 number is inflated by two things operating at the same time: the delayed retirement credit, which gives you 8% per year between 67 and 70 for a permanent 24% increase, plus the assumption of 8 more years of salary. If you are planning to retire at 55 and claim at 70, the age 70 number on your statement is not your number. It is the number for someone who works another 15 years earning what you earn today. Let that sink in. That number assumes you kept earning your current salary from age 55 all the way to 70. If you stop at 55, you are not putting those 15 years of earnings into the system. Your actual benefit will be lower, possibly hundreds of dollars lower every month for the rest of your life. The tension here is real. The statement's own disclaimer, buried in the fine print, tells you that actual benefits may differ because earnings may increase or decrease. But the default assumption, the one that prints the big number, is the optimistic one. The 30% permanent reduction if you claim at 62 is real. The 24% boost if you wait until 70 is real. But the gap between those numbers on your statement is not only about the delayed credits, it is also about the assumption that you will keep contributing to the system for 8 more years. The statement does not separate those two effects. It shows you one number and lets you assume that number is what you will get. If you stop working at 55, that age 70 number is wrong, could be thousands of dollars per month wrong. And the statement does not tell you that. It shows you the number. The Social Security Administration's own 2020 study, the same briefing paper, admits that the estimates are fairly accurate for older workers, but less realistic for younger workers, especially those under 50. The statement is a starting point, but it is a starting point built on a series of assumptions that may not match your reality. The first assumption, that you will keep working until you claim, is the one that sets the trap. It makes the age 70 number look artificially high if you plan to stop early, and it makes the age 62 number look artificially low if you plan to keep working past 62. Either way, you are getting a number that does not belong to you. Let us dig into the first assumption in detail. The first assumption is about how your benefit is actually calculated. The Social Security Administration uses a formula that takes your highest 35 years of earnings, adjusts them for wage growth, and averages them into a monthly number called your average index monthly earnings, or AIME. Past earnings are wage indexed to age 60 using the National Average Wage Index. That means a year you earned $60,000 at age 30 gets inflated upward to reflect the economy's growth. By the time you turn 60, so older high-earning years carry more weight than younger ones, even if the nominal dollars were smaller. If you stop working early, you might not have 35 years of covered earnings. Each missing year gets filled with a zero. That zero drags down your average. And because the indexing rewards later in life earnings, dropping a year from your 50s when your salary was highest and replacing it with a zero can hit your AIME hard. Even if you have 35 years, the marginal impact of one more year depends on whether that year would replace a lower indexed year from earlier in your career. If you earned $100,000 at age 55, indexed upward, it could be worth more than a year where you earned $60,000 at age 30, also indexed. So the statement's assumption that you'll keep earning your current salary until you claim is not just optimistic, it's the foundation of the whole projection. Now here's where the math gets interesting. Once your AIME is calculated, it gets run through a progressive formula designed to replace a higher percentage of earnings for lower income workers. The formula uses bend points, thresholds that determine how much of your AIME gets replaced. For 2026, the bend points are $1,286 and $7,749. The first $1,286 of your AIME is replaced at 90%. The next chunk from $1,286 up to $7,749 is replaced at 32%. Anything above that is replaced at only 15%. That progressive structure means each additional dollar of AIME is worth less than the previous one. If your AIME is $2,000, about 83% of your pre-retirement earnings get replaced. If your AIME is $11,400, the replacement rate drops to about 37%. So the bend points are the most powerful lever for lower income workers, and they're completely invisible on your statement. The statement just shows you the final number without explaining how it got there. But there's another layer of hidden trap. The statement uses current year bend points, not projected ones. So if you're 40 years old and looking at your statement today, the bend points are set at 2026 levels. When you actually turn 62, the bend points will be higher adjusted for national wage growth. That means the statement's estimate for a younger worker is actually understated on the bend point side, even as it's overstated on the earnings assumption side. The Social Security Administration's own 2020 study found that the benefit estimates are fairly accurate for older workers, but less realistic for younger workers, especially those under 50. You're getting a projection built on a mix of optimistic and pessimistic assumptions that don't even match your real plan. If you're planning to retire early, this is where the gap between your statement and reality starts to widen. The statement assumes you'll keep working, it assumes current bend points, and it assumes you'll have 35 solid years. If you stop at 55, you might have 35 years, but dropping a high indexed year can still reduce your AIME. And if you have fewer than 35 years, zeros fill the rest. The statement doesn't tell you any of this. It gives you a number and lets you assume it's what you'll get. Subscribe to the channel so you don't miss the next part, because this is only the first assumption. There's a second one that's even more subtle. That second assumption is about the age 70 estimate. It assumes you earn your current salary for 8 more years on top of the delayed credits. So the number you see for age 70 is inflated by two things at once: the permanent 24% boost from delaying and the assumption of 8 more years of salary. If you plan to retire at 55 and claim at 70, that age 70 number assumes you earned your current salary for 15 more years. That is a completely different financial reality than someone who actually stops working at 55. Consider a specific case. You earn $80,000 a year at 55. The statement shows an age 70 benefit that assumes you keep earning that $80,000 every year for 15 more years. That is $1.2 million in additional earnings flowing into the system. Earnings that, according to the statement's assumption, will be included in your top 35 years. But if you actually stop at 55, that assumed income disappears. Your AIME calculation suddenly has 15 fewer years of high earnings to choose from. The worst part? The statement does not tell you that the age 70 number is inflated by both the delayed credits and the extra earnings. It presents one number and lets you think it is all because of waiting. The delayed retirement credit is real. You do get an extra 8% per year from full retirement age to 70. But the extra earnings assumption only matters if those years replace low earning years in your top 35. If you already have 35 solid years of high earnings, each additional year adds very little to your benefit because the bend point formula caps the replacement rate on high earnings. For a high earner, the top bracket replaces only 15% of additional earnings above $7,749 a month. So the earnings boost from working extra years might be worth almost nothing. The statement is giving you a number that assumes both the delayed credits and the earnings boost, but the earnings boost might be negligible. The government's own calculator is designed to show you the maximum possible number, not the realistic one. The Social Security Administration's own 2020 study, the same one that confirmed the estimates are less accurate for younger workers, noted that the assumption of continued earnings at the same level is the biggest source of error. The statement's disclaimer, buried in the fine print, acknowledges that earnings may increase or decrease. But the big number on the front page is the one that grabs you. You do not read the fine print until something goes wrong. By then, you have already anchored on that inflated number and built your retirement plan around it. This is the mainstream financial betrayal moment. The system that is supposed to help you plan your retirement is giving you a projection that is systematically overestimated if you plan to stop working before full retirement age. It is not malicious. It is a straightforward projection using current data. But the net effect is that you are making decisions based on a number that does not match your reality. And if you are like most people, you have never questioned it. You have never logged into the SSA's online calculator and changed the stop working at age field to see what your actual benefit would be. That calculator exists, it is free on the SSA website, and it lets you input a projected retirement age. But the statement itself does not point you there. It shows you the number and lets you assume it is accurate. You anchor on that number. You plan your retirement spending, your savings target, your withdrawal rate around it. But if you are retiring early, that number is inflated. You might think you have more Social Security income coming than you actually will. That gap can lead to a shortfall in your later years, when you need the money most. The betrayal is not that the statement is wrong on purpose. It is that the default assumption is designed for a standard career path, not for anyone who wants to stop working before full retirement age. And the statement does not warn you about this. It gives you a number and leaves you to discover the flaw on your own. So if you are planning to retire early, your statement is likely overstating your benefit. That is the bad news. But there is a strategy that flips this to your advantage, and I will get to that after we cover one more assumption that works in the opposite direction. So the overestimation you've seen from the first two assumptions, the work until you claim assumption and the double counted age 70 number, is not a small rounding error. It's baked into the default projection the government hands you every year. And the mainstream financial advice, the max your 401k and wait until 65 dogma, relies on those inflated numbers. If your statement says you'll get $2,500 at 67, but your real number is closer to $1,800 because you stop working at 55, that's a gap that compounds into tens of thousands of dollars over your retirement. The advice assumes the statement is accurate, and the statement assumes you keep working. It's a loop that works against anyone who doesn't want to work until their full retirement age. The strategy that flips this is called the Social Security bridge. Instead of claiming early and locking in a permanent reduction, you retire when you want to. Use your portfolio to cover expenses from early retirement to age 70, and then claim the maximum benefit, the 24% delayed credit, plus any intervening cost of living adjustments. The difference between claiming at 62 and 70 amounts to about 77% more in monthly income. That's not a typo. For a $2,000 primary insurance amount, that's $1,400 a month versus almost $2,500. The internal rate of return on delaying is 5 to 6% real, which beats any bond you can buy today. The break-even age is around 80 to 81, meaning if you live past that, you come out ahead. And because the progressive formula already subsidizes the first $1,286 of your AIME at 90%, the delayed credits compound on a base that's already heavily supported. The higher your earnings, the more sense this makes. The 15% bracket on earnings above $7,749 means each additional working year adds very little to your benefit. So the cost of retiring early is small, while the gain from waiting is large. Here is the part that never makes it into a retirement calculator. Knowing these numbers and actually building a system around them are two entirely different things. I had the same data on my own statement 5 years ago, and it did not change anything until I sat down and worked through the math systematically. That's why I built a digital book called The Exit Code. It's an analysis of 50 years of actual retirement data distilled into a mathematical framework for exiting the rat race. The Social Security Bridge chapter walks you through exactly how to time your claiming, how much portfolio you need to cover the gap years, and how to avoid the traps that cause many early retirees to go back to work and it had nothing to do with money. The book also includes the mathematical framework that turns maybe someday into a specific date. You can get it for less than a dinner out through the link in the description. If you're finding this useful, hit subscribe. We're just getting to the counterintuitive part. Now, the third assumption in your statement actually works the other way. It can quietly shrink your check if you're not careful. The third assumption hidden in your statement is the assumption that you will not work while collecting benefits. And the earnings test is the concrete rule that catches you off guard. In 2026, If you are under full retirement age for the entire year, you can earn up to $24,480 without any reduction. That is the exempt amount. For every $2 you earn above that limit, the Social Security Administration withholds $1 of your benefits. So if you earn $50,000 a year at age 64, you are $25,520 over the exempt amount. That means $12,760 of your benefits gets withheld. For a typical benefit of $1,800 a month, that is $21,600 annually. Withholding $12,760 means you lose more than half of your annual benefit for that year. It is a significant reduction in your cash flow. Now, the year you reach full retirement age, the rules change. In the months before your birthday, you can earn up to $65,160, and then $1 is withheld for every $3 above that. After you hit full retirement age, the earnings test disappears entirely. You can earn any amount and your benefits are not reduced. So the earnings test only applies if you claim before your full retirement age, which is 67 for most people born in 1960 or later. The common misconception is that the withheld benefits are lost forever. That is not true. The withheld dollars are not confiscated. They are not a permanent penalty. Instead, the Social Security Administration recalculates your benefit upward at your full retirement age to account for the months that were withheld. The credit is spread over your remaining lifetime. So if you live a long time, you will eventually recoup the full amount. But if you die early, you might not get back all of it. The key point is that the withheld dollars are deferred, and you get them back in the form of a higher monthly check later. Let me explain the recalculation. When benefits are withheld, the Social Security Administration treats those months as if you did not claim benefits for that period. At your full retirement age, they recompute your benefit by factoring in the months of deferral, effectively giving you delayed retirement credits for those months. So instead of losing the money, you are forced to delay claiming for those months, which increases your future benefit. The increase is calculated based on the 8% per year delayed credit, but only for the months affected. So the net effect is that you are not penalized. You are receiving your benefits later, which means you get a higher monthly amount for the rest of your life. The trap is that the recalculated benefit spreads the credit over your expected remaining lifetime. If you die earlier than the actuarial tables predict, you might not receive the full value of the deferred benefits. But for most people, especially those who live to average life expectancy, the recalculation works out. It is not a loss. It is a timing shift. Now, the statement does not show you any of this. It gives you a number that assumes you are not working. And if you are planning to work at all while collecting before full retirement age, that number is not your number. You need to factor in the earnings test, and you need to understand that the withheld dollars are not lost. That distinction matters a lot for your planning. If you are counting on a certain amount of cash flow from Social Security at age 62 and you plan to work part-time, you need to know that your actual checks will be lower for the first few years, but your benefit will be higher later. The earnings test is often misunderstood. People fear it and rush to claim at full retirement age to avoid it, even though claiming earlier might make sense for their health or family situation. But the statement does not help you navigate this decision. It presents a clean number, and you are left to discover the earnings test on your own. The fine print in the statement does mention that work may affect benefits, but it does not explain the math or the recalculation. So you are left with a number that is correct only if you never work again after claiming. So the earnings test can reduce your early checks, but it is not as bad as it sounds. Now, let us put it all together and talk about the strategy that actually works. That strategy is the Social Security bridge, and it turns the statement's hidden assumptions from a trap into a lever. You retire when you want to say 55, 58, whatever your number is, and you do not claim Social Security yet. Instead, you use your own portfolio to cover your living expenses from the day you stop working until you turn 70. That portfolio can be cash, taxable brokerage accounts, Roth conversions, or even part-time work. Then at 70, you claim the maximum benefit you are entitled to, which includes the delayed retirement credits, 24% more than your full retirement age amount, plus any cost of living adjustments that accumulated during the years you were waiting. Those COLAs compound during the delay period too, because the benefit base is adjusted upward each year, even though you are not collecting yet. The longer you wait, the higher the starting point for the rest of your life. The math on this is brutal in the best way. If you claim At 62, your benefit is permanently reduced by 30%. You get 70% of your primary insurance amount. If you wait until 70, you get 124% of that same primary insurance amount. That is a difference of about 77% more money every month for the rest of your life. Take a real example. Someone with a primary insurance amount of $2,000. That's roughly the average for a moderate earner who worked 35 years. At 62, they get $1,400 a month. At 70, they get $2,480. That is an extra $1,080 a month, every month, adjusted for inflation for as long as they live. The internal rate of return on that delay is somewhere between 5 and 6% real, meaning after inflation. Compare that to a 10-year treasury bond yielding 4.5% nominal, or a corporate bond yielding maybe 5.5% before taxes. The Social Security bridge is effectively buying an inflation-adjusted annuity with a guaranteed return that beats almost anything in the bond market right now. And unlike a commercial annuity, there is no insurance company markup, no surrender charges, no counterparty risk. The guarantee is backed by the full faith and credit of the United States government. Why does this work so well? It comes back to the progressive formula you already saw. The first $1,286 of your average index monthly earnings is replaced at 90%. That is a government subsidy. The benefit you get is already heavily weighted toward the lower brackets of your earnings history. The delayed retirement credits compound on top of that subsidized base. So you are not getting 8% per year on your own contributions. You are getting 8% per year on the entire benefit, including the 90% replacement on the first bracket. That leverage is what makes the numbers work. The higher your earnings, the more sense this makes. Because the 15% bracket on earnings above $7,749 means each additional working year adds very little to your benefit. The cost of retiring early is small, while the gain from waiting is large. The break-even age for claiming at 70 versus 62 is typically around 80 or 81. If you live past that, you come out ahead by waiting. And given that the average 65-year-old man today lives to about 84, and the average woman to about 87, the odds are in your favor. The real risk is not dying young. The real risk is living longer than you planned and running out of money. The bridge strategy hedges against that by giving you a higher guaranteed income floor in your later years. It flips the statement's hidden assumption on its head. Instead of assuming you will work until you claim, you assume you will stop working early and use your savings to buy a bigger check later. Now, if you already have 35 strong years of earnings, stopping work early does not hurt your benefit much. The marginal impact of one more year might be tiny because the bend point formula caps the replacement rate on high earnings. The real gain comes from waiting to claim, not from working longer. That is a counterintuitive truth that the statement's assumptions completely obscure. The statement's age 70 number is inflated by the assumption of extra salary, but the actual benefit increase from waiting is almost entirely from the delayed credits. So if you have a solid 35-year earnings history, you can retire at 55, use your portfolio for 15 years, and then collect a benefit that is significantly higher than what you would get by claiming at 62. The cost of those lost years of salary is small, while the gain from waiting is large. But there is a catch. You need to have enough savings to cover the gap years. That is where the calculation becomes specific. If you retire at 55 and claim at 70, you need to cover 15 years of expenses. That's 15 years where your Social Security check is zero. You have to pull that money from somewhere else. The obvious source is your portfolio. How much do you need? It depends on your spending, but let's use a concrete example. Say you need $40,000 a year after taxes. That's a modest retirement for a couple in many parts of the country. 15 years times 40,000 is $600,000 in today's money, assuming you earn zero real return on that money during the gap, but you will earn something. If you earn a 2% real return after inflation, you need about $515,000. If you earn 4%, about $445,000. That's a big range, and it's the first thing you have to calculate for yourself. The real calculation is more dynamic because you're drawing down the portfolio while it's still invested. A common approach is to use a separate bucket of cash or bonds for the first 5 years of the gap, so you don't have to sell stocks in a downturn. The rest of the portfolio stays invested in a mix of stocks and bonds, and you draw from it at a rate that allows it to last the full 15 years. A conservative withdrawal rate for a temporary bridge like this can be higher than the standard 4% because you don't need the portfolio to last forever. You can spend it down to zero by age 70. A 6% withdrawal rate on a $500,000 portfolio gives you $30,000 a year, which combined with a separate cash bucket could cover the full $40,000. But the risk of sequence of returns is real. If the market crashes in year one and you're pulling 6%, you could run out earlier than planned. So you need to stress test your numbers. Now, the benefit you'll receive at 70 depends on your average index monthly earnings, which is based on your highest 35 years of earnings. If you stop working at 55, your AIME is locked in from that point. The maximum possible benefit for someone who becomes eligible in 2026, meaning they turn 62 that year, is $4,152 per month. That assumes you earn the maximum taxable amount in each of your 35 highest years. Most people won't hit that maximum, but even hitting half of it is a significant number. The important thing is that the statement's age 70 number is inflated because it assumes you keep earning your current salary for 15 more years. If you're earning $100,000 at 55, the statement might show a benefit of $3,200 at 70. But if you stop at 55, your real AIME is based on the 35 years you already have, not the 15 years of future earnings. Your actual benefit might be closer to $2,700. That's a $500 monthly gap. Over a 30-year retirement, that's $180,000 you were counting on. That isn't there. The way to get the real number is to use the Social Security Administration's online calculator.gov and use the retirement estimator tool. Tell it you'll stop working at 55, and it recalculates your benefit based on your actual earnings history with no future earnings assumed. That number is much closer to what you'll actually get. You should do that right now if you're planning to retire early. The statement's default is a fantasy. The calculator gives you a reality check. Now, here's where the statement underestimates. The statement shows all estimates in today's dollars, with zero future cost of living adjustments. That means the number you see is what you'd get in today's purchasing power. But if you delay claiming to 70, you'll receive cost of living adjustments every year from your full retirement age onward, even before you claim. The benefit is adjusted annually for inflation using the Consumer Price Index for urban wage earners and clerical workers. So if inflation runs at 2.5% per year, and you wait from 67 to 70, your benefit will be increased by those 3 years of COLAs on top of the 24% delayed retirement credit. The statement ignores that completely. So the nominal benefit you'll actually receive at 70 will be higher than the statement's number, even if the statement's earnings assumption was wrong. The bridge strategy captures both the delayed credits and the intervening COLAs, which is why it's so powerful. The bend point formula reinforces this for high earners. The top bracket, the one that replaces only 15% of your AIME above a certain threshold, means that additional high earning years add very little to your benefit. If your AIME is already above that threshold, working extra years after you've already maxed out your 35 best years adds almost nothing. The cost of not working those years is tiny, but the gain from waiting to claim is the full 24% delayed credit on your entire primary insurance amount. That creates a massive asymmetry. The bridge strategy works best for people with higher incomes because the foregone earnings are cheap and the delayed credits are expensive. You're effectively trading a low-value asset, extra years of salary, that only get 15% replacement for a high-value asset, a 24% permanent increase in your benefit. Now, let's put a number on the portfolio you need. Suppose your real benefit at 70 is $2,500 per month. If you claim at 62 instead, you'd get about $1,750. That difference of $750 a month or $9,000 a year is the income you're buying with your bridge portfolio. To generate $9,000 a year for 15 years, you need about $135,000 in today's money, assuming you earn zero real return. If you earn a modest 2% real return, you need about $115,000. That's a lot of money, but it's a fraction of what you'd need to replace your entire retirement income. And you're not spending that money, you're converting it into a higher guaranteed income stream for life. The internal rate of return on that conversion is excellent, far better than any bond you can buy today. But the calculation becomes specific to your situation. You need to know your actual AIME, your actual spending needs, and your actual portfolio size. The statement gives you a starting point, but you have to adjust for the assumptions. Now, all of this assumes you understand the assumptions. But there's one more hidden factor that most people miss. The bend points are fixed at age 62, and the statement uses current bend points, which can be lower. Here's how the bend point piece works. The bend points are set in the calendar year you turn 62. They are adjusted each year for national average wage growth. So if you are 40 years old today, the bend points that will apply to your benefit calculation when you turn 62 in 20 years will be substantially higher than the numbers on your current statement. But your statement uses today's bend points, the 2026 values of $1,286 and $7,749. That means the statement's estimate for a younger worker is actually understated on the bend point side. It uses a lower replacement threshold than what you will actually get at retirement. So the statement overestimates because of the work until claim assumption, but it underestimates because of the bend point assumption. Those two errors pull in opposite directions, and the statement gives you no way to untangle them. The same Social Security Administration study that admitted the estimates are less accurate for younger workers did not break down how much of the error comes from each source, but you can be sure the bend point piece is real. The effect is more pronounced the further you are from age 62. A 30-year-old looking at their statement today sees bend points that are decades old relative to when they will actually claim. The statement's estimate for their benefit at age 67 is built on the assumption that the bend points will stay at current levels, even though wage growth has historically pushed them up every year. That means the statement is undervaluing the replacement rate for the first two brackets of their AIME. The 90% bracket on the first $1,286 will apply to a larger slice of their earnings in real terms, because the bend points will be higher when they turn 62. So the statement's estimate is too low for that reason, but the work until claim assumption pushes it too high. The net effect depends on your age, your earnings trajectory, and how many years you plan to stop working before claiming. The statement does not tell you any of this. It gives you a single number and lets you assume it is accurate. Now layer in the taxable maximum. Social Security tax only applies to earnings up to a certain limit each year, and that limit for 2026 is $184,500. If you earn above that amount, the extra income is not subject to Social Security tax, and it also does not count toward your benefit calculation. So for high earners, earning beyond that limit adds absolutely nothing to your benefit. Combine that with the progressive formula, you already know the 15% replacement rate on the top bracket, and the picture becomes clear. If you are a high earner, working extra years after you have already maxed out your 35 best years adds very little. The marginal earnings are either above the taxable maximum or above the second bend point, where the replacement rate is only 15%. This is a structural feature of the system that makes the bridge strategy even more powerful. The cost of not working those extra years is low, but the gain from waiting to claim is the full 24% delayed credit on your entire primary insurance amount. You are trading a low-value asset, extra years of salary that barely nudge your benefit for a high-value asset, a permanent increase on a subsidized base. The statement is not designed to deceive you. It is a simple projection using current data. But the net effect for someone planning to retire early is that the statement overestimates your benefit because of the earnings assumption and underestimates it because of the bend point assumption. The combination is confusing, and the statement does not help you reconcile the two. You have to do that work yourself. The SSA's own online calculator lets you change the stop work age and will use projected bend points for future years. So that is the tool you should actually use. The statement is a starting point, but you need to adjust for your own plan. And that adjustment starts with your brain, not your spreadsheet. Because the hardest part of this whole puzzle isn't the bend points or the delayed credits or the earnings test. The hardest part is the fear that creeps in when you are 55 and looking at 15 years of portfolio withdrawals before you can touch the government check. Most people claim early not because the math favors it, but because they are afraid the money will not be there later, or they need the cash right now to cover a gap they did not plan for. That is a brain problem, not a math problem. You anchor on the statement's number, you fear the gap, and you grab the bird in the hand at 62, even though the bird in the bush at 70 is worth nearly twice as much. The data tells a different story. The real risk is not that Social Security will run out of money or that you will die before you collect. The real risk is that you will live longer than you planned and run out of everything else. A higher guaranteed income floor at 70 is the best hedge against that. Lazy investing built more fortune than crypto memes. The people who win in retirement are not the ones who obsess over daily market moves or chase the next hot stock. They are the ones who understand the structural advantages built into the system and exploit them with patience. The Social Security bridge is exactly that kind of lazy advantage. You do not need to trade options or time the market. You need to understand the assumptions your statement is hiding, adjust your plan accordingly, and let the math work over time. Subscribe if you want more breakdowns like this. I am reading the documents that make your money work harder, so you do not have to. Your statement is a guide, not a guarantee. The math is on your side if you understand the assumptions. Now go check your statement and see what it is really hiding. The math work over time. Subscribe if you want more breakdowns like this. I am reading the documents that make your money work harder, so you do not have to. Your statement is a guide, not a guarantee. The math is on your side if you understand the assumptions. Now, go check your statement and see what it is really hiding.